आज आपण रेशिओ अनालिसिस हा चॅप्टर पाहणार आहोत. यापूर्वी तुम्ही 10वी मध्ये गुणोत्तर प्रमाण हे पाहिलेलं आहे. त्याच पद्धतीनं रेशिओ अनालिसिस हे पाहणार आहोत. रेशिओ अनालिसिस is an important quantitative techniques which is mostly in use for interpreting financial statements. This technique uses as a tool for assessing the current and long term financial soundness of concerned business. Ratio analysis used to analyze various aspects of operational efficiency and degree of profitability. The financial statement prepared by a business concern mainly of the profit and loss account and balance sheets. But ratio analysis covers all available financial facts for the period and are the intended to determine the concerned business soundness from the viewpoints of the stakeholders, debenture holders, creators, and any investor would be interested to know whether his investment is safe and he get some good return. The profit and loss account shows only the result of the trading for the particular period, and balance sheet shows only particular of the asset and liabilities of the business. As these financial statements cannot give a full complete scenario of the financial position of the business, but ratio analysis give various items appearing in the financial statements. He give accurately financial health and capability of the business. The Latin word ratio stands for a reason. In accounting, ratios relates to the ratio expressed in mathematical terms by analyze accounting data contained in a published account or financial statement. In financial analysis, the relationship may be expressed as a rate of percent as a content of this percentage is most popular one. A ratio is defined as a relationship between the two numbers of the same kind. Ratio analysis is one of the most useful and common method to analyzing the financial statements, and ratio enables the mass of data to be summarized and simplified. Then absolute, the figures or data are valuable, but they standing alone convey meaning unless the compared with another. The ratio analysis, thus the quantitative tool, enable analysis to draw the quantitative answers to question such as are the profitability adequate, then are the asset being used efficiently, then is the firm are solvent, can be the firm meet to its current obligations, and so on. So many questions given the ratio analysis. The next point, classification of data. Then first classification, profitability ratio. Profitability should be distinguished from profits, and profitability ratios are in relation to sales. To profit margin measures the relationship between the profit and sales. As the profit may be a gross or net, the ratio consists of profit margin, that the gross profit ratio, net profit ratio, expenses ratio, then operating ratio, a measure of profitability is the overall measure of the companies with regard to efficient and effective utilization of resources. Then profitability ratio indicate effectiveness of decisions taken by the management. The first profitability ratio is the gross profit ratio. The gross profit ratio is the oldest and widely used financial ratio. This ratio is the set up by comparison of the gross profit with net sales. It expenses the relationship gross profit ratio on sales. It representing the percentage of gross profit earned on sales. This is also called turnover ratio. The formula of gross profit ratio is gross profit ratio is equal to gross profit divided by net sales into 100. For example, if the sales of a firm amount to rupees 25 lakh and its gross profit are rupees 5 lakh, calculate the gross profit. Then solution, gross profit ratio is equal to gross profit divided by net sales into 100. Then gross profit 5 lakh divided by 25 lakh into 100 is equal to 20 percentage. 20%. The percentage of gross profit ratio on sales 20%. This indicate the margin of profit on sales. A high ratio of gross profit to sales is a sign of good management, and it implies that the cost of production of the firm is low, and high gross profit ratio is better profitability of the product and sold by the company. Then second ratio, net profit ratio. This ratio is very useful to the proprietors and investors because it rivals the overall profitability of the concern. This ratio is ascertained by finding out between the net profit to net sales. It is also known as a net profit margin ratio. The ratio of net profit to sales essentially expenses and the cost price effectiveness of the operation. Formula of net profit ratio. The net profit ratio is equal to net profit divided by sales into 100. For example, if the sales of a firm amount to rupees 5 lakh and its net profit are rupees 1 lakh, 1 lakh. Calculate the net profit. Then net profit is equal to net profit divided by sales into 100 equal to 1 lakh divided by 5 lakh into 100 is equal to 20%. The net profit ratio is equal to 20%. Net profit ratio rivals to overall profitability of the business. The net profit margin is indicative of management's ability and to operate the business effectively. A high net profit margin would be ensure adequate return to the owners. High net profit ratio is considered as a good ratio, as well as a low net profit ratio indicate that the company has a poor profitability as compared to that of the industry. Then third ratio, operating ratio. The operating ratio relate to income for measuring profitability of an enterprise. Operating ratios are generally expressed in percentage. This ratio of cost of goods sold plus operating expenses of net sales. Operating expenses consist administrative and selling and distributing expenses. This ratio is closely related to the ratio of operating profit to net sales. The formula of operating ratio is operating expenses divided by net sales into 100. Then second formula, operating ratio is equal to cost of goods sold plus operating expenses divided by sales into 100. Then what is operating ratio? Operating ratio is equal to administrative expenses plus selling and distribution expenses. Then administrative expenses are rent, insurance, office salaries, director fees, legal expenses. These are the operating expenses. Then selling expenses are salary to salesman, advertising, traveling expenses related to the selling and distribution expenses. This is called the selling and distribution expenses. Then what is cost of goods sold? Cost of goods sold is the opening stock plus purchase plus direct expenses minus closing stock. It is called a cost of goods sold. Then the second formula is cost of goods sold plus operating expenses divided by sales into 100. This is called the operating ratio. And then the operating ratio shows the percentage of net sales that is the cost of goods sold and operating expenses. This is a test of efficiency of the management of the operations. It means of operating efficiency is the normal condition. The operating ratio should be low enough so as to leave a position of the sales sufficient to give the fair return to the investor. When the more capital is needed, the operating ratio should be lower. Then next ratio is a liquidity ratio. The next types, the liquidity. Liquidity. The main purpose of computing liquidity ratio is to analyze the current financial soundness of the business. They are very useful to all parties who are interested in current financial health of the business. Those concerned with it may include, among others, investors, bankers, suppliers, and creators. The main ratios in this group, which is are significant, are the current ratio and quick ratio, liquid ratio. The commercial banks and short-term creators are primarily concerned with the analyze short-term financial position. It is an important to management in checking the efficiency which working capital is the being employed in the business. It is also important to shareholders and long-term creators to determining is to the same extent. At least the prospectus dividend in the interest. Number one, current ratio. The current ratio is also known as a working capital ratio and solvency ratio. Express the relationship between the current asset and current liability. Current asset comprise those assets like cash balance, like that the cash in hand, bank balance, cash at bank, stock, inventories, sundry debtors, bills of exchange, prepaid expenses, short-term loan, advances, short-term investment, while the current assets. Then some current liabilities are concerned to comprise the sundry creditors, bills payable, outstanding expenses, bank overdraft, provision for taxation, proposed dividend, unclaimed dividend, accrued interest on debentures, loans, long term debts. This is called the current liability. Then the formula of current ratio is the current asset divided by current liabilities. And current ratio is called as a working capital ratios. Then second ratios is quick ratio. Quick ratio. Liquid is also known as a quick asset ratio and acid test ratio. Liquid ratio is more rigorous test and liquidity than the current ratio. It gives the better picture of the firm's ability to meet the short-term debts and short-term assets. Quick or liquid assets include all current assets excepting stock and securities are held in temporary and which can be released without difficulty are also included. The stock is not liquid asset. It cannot be covered immediately into cash. Quick liability include all current liabilities excepting bank overdraft. Formula of quick ratio is equal to current asset minus inventory and current liability divided by current liability. This is called the quick ratio. Then next ratio, inventory turnover ratio. Inventory turnover ratio is also known as a stock turnover ratio. This ratio establishes a relationship between cost of goods sold and average inventory. This ratio prepared to ascertain number of times the stock is turned over during the period. This ratio indicates whether the inventory has been efficiently used or not. The purpose being check up whether only a required minimum capital has been looked up in inventory. This is called the inventory turnover ratio. Then formula of inventory turnover ratio is cost of goods sold divided by average inventory. And cost of goods sold is equal to opening stock plus purchases plus direct expenses minus closing stock is called as a cost of goods sold. And then the average stock is equal to opening stock plus closing stock divided by 2. This is called average stock. This ratio shows the higher ratio indicate the efficient of performance and lower rate suggest the same tips should be push up the sales. This is called the inventory turnover ratio. Then next ratio, debtors turnover ratio, is also known as the account receivable turnover ratio. This is called ART ratio. And this ratio establishes a relationship between the credit sales and average trade debtors. The objective of calculating this ratio to determine the efficiency with which the trade debtors are managed, and this is prepared to find out how many days credit is outstanding by debtors. Prompt average debt collection period indicate whether or not book debts are being collected promptly and to extent which is the credit policy regarding the credit period is being adhered. Debtors or receivable are used in context include the amount of bills receivable. The formula of account receivable turnover ratio is equal to net credit sales divided by average account receivables. The purpose of debtors turnover ratio is to ascertain after how much time debtors make a payment. To serves as a check of collection of outstanding. It is if the average data is alone is long, an immediate step be taken collect outstanding. A low debtors turnover ratio indicate the risk and cost collection of debtors is increasing. Next, creditors turnover ratio. The creditors turnover ratio, also known as a account payable ratio, creditors velocity ratios, and these ratios expenses relationship expresses the relationship between credit purchase and average trade creditors. This ratio objective to computing this ratio is to determine the efficiency which with which the creditors are managed. One should ascertain whether the firm is enjoying actually the credit promised by suppliers. Here, creditors will also include bills payable. Average creditors is calculated by dividing the total opening balance and closing balance of creditors by 2. Creditors turnover ratios formula is the average account payables divided by net credit sales, net credit purchases into number of working days. Then next ratio, proprietary ratio. The proprietary ratio, also called as a capital ratio or equity ratio. Proprietary ratio measures a relationship between total asset and proprietor's fund. That is called a shareholders fund. And the objective of this ratio is to find out how the proprietors have financed the assets. Proprietor ratio is very useful to determine long-term solvency of the company. Proprietor ratio formula is equal to proprietor funds or shareholder funds divided by total assets into 100. That is called the proprietor ratios. Then next point, advantages of ratio analysis. Ratio analysis is very useful tool in the hands of management. It is an instrument for diagnosis of the overall financial health of an enterprise. It functions as a sort of health test. It is primarily used by management in the discharge of the basic functions for forecasting, planning, coordination, business operations, communication, controls, and the ratio analysis. The way of effective control of business operations. Ratio analysis is very useful for measuring the performance. It is very useful the control, cost control also. Then some advantages. The first advantages is the easy understanding and financial statements. Ratio analysis facility and comparison of financial statement by the simplifying, summarizing a large number of accounting figures. It facilitates evaluation the several aspects on the financial health, profitability, operational efficiency of the undertaking. Then second advantage is decision making. Ratio analysis help the investment of decisions in case of the investors and lending decisions in case of bankers, financial institutions, the credit supplier, institutions, investors, and all use ratios analysis of the initial the tool for the evaluating company affairs. Then number third, planning and forecasting. Ratio analysis help the planning and forecasting. Ratio related to past sales, profit, and financial position may be used for forecasting figures. In recent years, ratios have been used as a measure of prediction of events. Ratios are being used in warning system to indicate the failure of companies. Then fourth and last advantage, inter-firm comparison. Ratio analysis provide data to inter-firm comparison to the measure efficiency and help the management to take a remedial measures. Ratios highlights the strong point, weak point of the company comparison to the companies in the industries. These are some advantages of the ratio analysis and some limitations. of ratio analysis. The first limitations is the limited use of single ratio. The ratio can be useful only when they are computed in the significant large number. A single ratio could not be able to convey anything. It is same time into many ratios are calculated. They are likely confused instead and rivaling the meaningful conclusion. Then second limitation, lack of quantitative analysis of problem. Ratio analysis gives only a good basic quantitative analysis of financial problem, but suffers from the quantitative aspects. Then third limitation, lack of proper standards. While making the comparison, it always the challenging of job. Find out the adequate standard. It is not possible to calculate the exact, well accepted absolute standard. It is a quality range. It is regarded as satisfactory, and therefore the standard will differ each industry and circumstances. Each firm will have to keep the mind. Then next, past is not the indicator of future, and then next, background is overlooked. Then not allowance for change in price level and limited uses. There are some limitations, and the limited use ratio analysis is not suitable substitute for the sound judgment rather than the helpful tool and applying the judgment and otherwise complex situations. So the conclusions drawn with help in ratios should be verified and other techniques too. Thank you.